This is Scott Becker with the Becker Private Equity and Business Podcast. We try and come to you regular with short business episodes, short private equity episodes. We often feature technology being sold into private equity sponsored companies and a lot more. Today's discussion is Disney slows. So here's what's going on with Disney. Disney's parks business, which is about 36 to 38% of their business, is showing significant softness and slowing, and it's a big part of their business. It's one of the reasons, notwithstanding the Disney Plus and the streaming business going pretty well, the stock is just up 3% year to date, while the rest of the market, the S&P, is up 20% year to date. What we're seeing at Disney is lower demand for their parks business, families getting to that tipping point where it costs so much. It reminds me of ski resorts, where they've raised the cost so much to go to a ski resort that you're starting to see a softening of demand. We'll start to see at the end of the day whether Disney could continue to sustain growth as a company as its park business slows. It's always been one of the critical crown jewels of the Disney empire and originally built around it. But then, of course, it's Disney Films, it's the streaming, it's everything else too. But this Disney parks business starting to show some warts and some challenges. We'll see how that goes. Thank you for listening to the Becker Private Equity Business Podcast. We come to you regularly, trying to make sure you learn a little something, you entertain some. I mean, obviously, when we look at Disney, we always try and take some shots at Bob Iger, who's a fantastic executive, but also has an ego that's an outsized ego. Thank you for listening to the Becker Private Equity and Business Podcast. Thank you very much.